Hi, welcome back to the channel. If you've been watching silver prices lately, you've probably noticed something strange. On one hand, you have major financial institutions quietly revising their targets and pulling back on some of their more optimistic forecasts. On the other hand, you have physical silver being pulled out of COMEX warehouses at a pace that is genuinely difficult to ignore. So which signal do you follow? The big banks adjusting their numbers downward, or the actual physical movement of metal out of registered vaults? That's exactly what we're going to work through today, because this tension between paper market expectations and physical market reality is one of the most important dynamics happening in the silver space right now. Before we dive in, I want to set the stage for why this moment matters. We're not just talking about a metal going up or down a few dollars. We're talking about a structural situation that has been building for several years, and 2026 is shaping up to be a year where several of those pressures arrive at the same time. Federal Reserve rate expectations, Goldman Sachs revising targets, COMEX delivery dynamics, industrial demand, geopolitical delays, all of it is converging. So let's take this step by step and make sure you understand what's actually happening and why it could matter for everyday people who are paying attention to their financial future. Let's start with Goldman Sachs because that's the headline that caught a lot of people's attention. Goldman cut some of its precious metals price targets. Now, when Goldman does something like this, markets notice. They're one of the most closely watched institutions on Wall Street. But here's the thing, and this is important. A target cut from a major bank is not a death sentence for an asset. If you look at the history of major bank forecasts on precious metals, you'll find a somewhat uncomfortable pattern. Big banks have repeatedly underestimated how high gold and silver can go during periods of structural stress. The revision tells you something about where sentiment is right now, but it doesn't necessarily tell you where the fundamentals are pointing. So why did Goldman cut targets? The primary reason comes down to Federal Reserve rate expectations. Here's how this works. When investors believe the Fed is going to keep interest rates higher for longer, or when rate cuts that were previously expected keep getting pushed back, that changes the calculation for holding precious metals. The logic goes like this. Gold and silver don't pay interest. They don't generate a dividend. So in a world where you can park your money in a treasury bond and earn a meaningful yield, the opportunity cost of holding physical metal goes up. That opportunity cost argument is real, and it's one of the main reasons precious metals sometimes struggle in high-rate environments. Now in 2026, the Fed's path has been anything but clear. After several years of aggressive rate hikes, there was broad expectation coming into the year that cuts would arrive relatively quickly. But inflation has proven stickier than many economists predicted. Geopolitical developments, including ongoing trade tensions, supply chain disruptions, and the lingering effects of conflicts in multiple regions, have kept energy prices somewhat elevated, which feeds back into inflation readings. The result is that the Fed has been slower to cut rates than the market was hoping for. And when rate cut expectations get pushed back, gold and silver face near-term headwinds. That's the environment Goldman Sachs is responding to when it adjusts its targets. Think about it this way. Imagine you're planning a road trip, and you've been told there will be no traffic. You plan your route based on that assumption. Then, halfway through your planning, someone tells you actually there's going to be significant traffic for the first half of the journey. You'd adjust your time estimate, right? But your destination hasn't changed. Goldman cutting targets is a bit like that. It's an adjustment to the timeline, not necessarily a statement that the destination has changed. Let's break this down a little further, because rate expectations don't exist in a vacuum. There are several geopolitical factors that have been delaying the progress the Fed was hoping to make on inflation. One of the most significant has been the slow-moving situation in the Middle East. Earlier in 2025, there were genuine hopes that a U.S.-Iran agreement could stabilize oil supply dynamics and take some pressure off energy prices globally. Those hopes haven't fully materialized. The deal that many analysts were expecting has faced repeated delays, diplomatic back and forth, conditions that keep shifting, verification concerns, and every delay means oil markets stay a little more uncertain than they would otherwise be. When oil stays elevated or volatile, it creates what economists call a cost-push inflation dynamic. The price of energy feeds into the price of almost everything else, from manufacturing to transportation to food. And that makes the Fed's job harder, keeping rates higher for longer, which circles back to the headwind for precious metals. Here's what this means for the average investor trying to make sense of all this. When you see headlines about Goldman cutting targets, or the Fed holding rates steady, it's tempting to treat that as a clean bearish signal for silver. But that's an incomplete picture, because at the same time those headlines are appearing, something very different is happening in the physical market. Let's talk about COMEX. If you're not familiar, the COMEX is the primary exchange in the United States where futures contracts for metals like gold, silver, copper, and platinum are traded. Most trading on the COMEX is done in paper form. Futures contracts that represent an obligation to deliver or receive a certain amount of metal at a specific future date. The vast majority of these contracts never result in actual physical delivery. Traders buy and sell them purely for price exposure, and they close out their positions before delivery is required. That's how it has worked for decades. But there's a subset of participants who actually take physical delivery. These are entities, sometimes industrial users, sometimes investment funds, sometimes foreign buyers, who want the actual metal, not just the price exposure. And the metal that gets delivered comes from what's called registered inventory at COMEX warehouses. Registered inventory is the metal that vault operators have specifically certified as available for delivery against a futures contract. There's also eligible inventory, which is metal stored at COMEX vaults but not yet certified for delivery. It's sitting there, but it's not formally available to be called upon to settle a contract. Now here's where things get interesting. COMEX registered silver inventory has been declining. When you look at the drawdown pattern over recent months, it's not a dramatic single-day event, it's a steady, persistent reduction. Registered ounces are moving out of vaults. Some of that metal is being reclassified to eligible. Some of it is leaving the system entirely. And when registered inventory drops while open interest, the total number of outstanding contracts remains elevated. You get a situation where the ratio of claims to available metal tightens. The coverage ratio starts to look increasingly stretched. Let's use an analogy to make this concrete. Imagine a restaurant that can seat 100 people at a time. They accept reservations, and right now they have 200 reservations booked for the same evening. As long as most people cancel before they show up, the restaurant can manage. But what happens if more people start actually showing up than usual? The restaurant can't seat everyone. There aren't enough tables. That's essentially the dynamic being watched in COMEX silver right now. Most contract holders roll or close their positions. They cancel, in effect. But if a higher than expected percentage start demanding physical delivery, the registered inventory has to be there to cover it. And the inventory that's there has been declining. Now why is this happening? The answer connects directly to silver's structural supply deficit. For several years running, global silver demand has exceeded global silver mine supply. The gap has to be filled from somewhere, typically from above-ground stockpiles, scrap recycling, and inventory drawdowns. Industrial demand for silver has grown substantially, driven by solar panel manufacturing, electric vehicle production, semiconductor fabrication, and increasingly by the infrastructure required for artificial intelligence. Data centers, server components, and advanced electronics all use silver. Meanwhile, mine production has not kept pace. Mining is slow to respond to higher prices because bringing a new mine online takes years of permitting, development, and capital investment. So you have demand growing faster than supply can respond, and that creates a deficit that has to be resolved somehow. When silver sits in a COMEX vault as registered inventory, it represents metal that could theoretically be tapped. But if industrial users are drawing down their own stockpiles, if investment demand is pulling metal into private hands, and if mine supply isn't filling the gap fast enough, then the pool of available metal across the system gets smaller over time. That's the structural story behind what you're seeing in the COMEX numbers. Let me pause here for a second and just say, if you're finding this breakdown useful and you want to keep getting this kind of clear, detailed analysis on precious metals and what's really moving markets, please hit the like button and subscribe to the channel. It genuinely helps this content reach more people who are trying to make sense of a complicated financial world. Now let's keep going, because we're getting to what I think is the most important part. The tension between the paper market and the physical market is something precious metals investors have discussed for years. And honestly, for most of that time, the paper market has set the price. Futures trading, algorithmic trading, institutional positioning, these have dominated price discovery. But there's a growing body of analysis suggesting that physical demand, particularly large-scale physical delivery demand, can eventually reassert itself. Not because anything dramatic happens, but simply because if physical metal becomes genuinely scarce relative to the claims outstanding, premiums rise, delivery becomes more difficult, and price eventually has to reflect reality. We're not there yet. Let's be clear about that. COMEX has not failed to deliver. There is still registered inventory. The system is functioning. But the trend in inventory is the signal that many analysts are watching carefully, a trend that has been consistently downward in registered silver inventory against a backdrop of rising industrial demand and a persistent supply deficit is a meaningful data point. It doesn't guarantee a price outcome, but it tells you something about the underlying tension in the market. Now let's connect this back to Goldman's target cut and the rate environment. Here's the thing that gets lost in a lot of mainstream coverage. Short-term price performance and long-term fundamental positioning are two different things. When Goldman cuts its near-term price target for silver, they're largely responding to the rate environment, the fact that higher-for-longer rates reduce the near-term appeal of non-yielding assets. That's a legitimate analysis. But it doesn't speak to the physical supply deficit. It doesn't speak to the COMEX inventory trend. It doesn't speak to the multi-year growth in industrial silver demand. These are different time frames and different frameworks. Think about it this way. If you have a house that needs significant repairs, a real estate analyst might tell you the near-term outlook is a headache. But if that house is in a neighborhood that is genuinely undervalued and structurally sound, the long-term thesis could still be intact. The short-term friction doesn't erase the underlying value dynamic. That's the kind of dual reality silver investors are navigating right now. Let's also touch on the geopolitical dimension of silver's supply chain, because this adds another layer. Silver mining is geographically concentrated. Mexico is the world's largest silver-producing country. Peru is second. Bolivia, Chile, China, and Russia round out the top producers. What this means is that political instability, regulatory changes in mining jurisdictions, currency issues, labor disputes, or environmental restrictions in any of these countries can ripple through global supply in ways that take time to show up in price but are very real in terms of available metal. Mexico has taken a more interventionist stance toward its mining sector, with regulatory changes slowing exploration and development. Peru has seen political instability that periodically disrupts operations at major mines. These aren't catastrophic single events, but they represent a slow accumulation of supply-side friction. Now, I want to be balanced here, because not every signal is pointing in the same direction. There are legitimate risks on the bearish side. The most significant is a sharp global economic slowdown. If the world economy slows meaningfully, industrial demand for silver could soften. Factories produce less, solar installations get delayed, and that reduces pressure on the supply side. Silver has a significant industrial demand component, which means it's more exposed to economic cycles than pure monetary metals. There's also the risk that the Fed's higher-for-longer stance persists longer than expected. These risks are real, and anyone who tells you silver is a guaranteed win is either misunderstanding the market or not being straight with you. That said, let's build a simple mental framework. There are really three layers to the silver story. The first is the macro-monetary environment, Fed rates, inflation, and institutional sentiment. Right now, this layer is a headwind. The second is the physical supply-demand fundamental, the structural deficit, industrial demand growth, mining supply constraints, and the COMEX inventory trend. This layer is constructive for silver over a medium to longer time horizon. The third is the catalyst question. What could bridge the gap? The most obvious catalyst is a clear Fed pivot to rate cuts. But others exist too, an acceleration in physical delivery demand on COMEX, a supply shock in a major mining region, or industrial demand that outpaces current forecasts. Most of the time in markets, Layer 1 dominates in the short run, and Layers 2 and 3 matter more over longer periods. That's a useful framing to keep in mind when you're consuming financial news. What does all of this mean for real people, for working professionals, for everyday investors, for folks who aren't watching COMEX inventory tables all day? The honest answer is that it depends entirely on your situation. Silver is a volatile asset. It can move dramatically in both directions over short periods. In 2020, it crashed with the rest of the market in March, then rallied nearly 100% by August of the same year. In 2022, it sold off even as inflation was running hot. It does not always behave the way simple logic would suggest, because markets are driven by positioning, sentiment, and liquidity flows in addition to fundamentals. What to watch going forward? First, watch Fed communication. Any shift in language about rate cuts would likely provide near-term support for silver. Second, watch COMEX registered inventory week to week. If the drawdown continues, that's a signal worth noting. If inventory rebuilds, the squeeze narrative is easing. Third, watch the gold-silver ratio. Silver has significantly lagged gold's performance. When that ratio eventually reverts toward historical norms, it typically means silver is catching up, and that catch-up can be rapid when it arrives, though timing it precisely is notoriously difficult. Fourth, watch geopolitical developments that affect oil prices, since those directly influence the Fed's timeline. There's one more thing I want to address, and it's something that's underappreciated in the mainstream financial media. The silver market is relatively small compared to most financial markets. Global silver mine supply is roughly around 1 billion ounces per year. Compare that to the global equity market, measured in the hundreds of trillions of dollars, or the foreign exchange market, where trillions change hands every single day. Silver is a small market, and small markets can move disproportionately when large pools of capital decide to flow in. The structural deficit in a small market gets resolved faster than it would in a large one, because there simply isn't as much buffer in the system. That's not a reason to expect a guaranteed outcome, but it is a reason why the physical dynamics in silver can have outsized price effects when conditions align. What we're watching right now in 2026 is a market caught between two powerful forces. The monetary policy environment and institutional sentiment are restraining price. The physical supply picture and structural deficit are building fundamental pressure underneath. These two forces don't stay in tension forever. At some point, one of them wins. Either the rate environment shifts, or the physical squeeze becomes tight enough that price has to reflect reality, or the economic cycle changes the demand picture. We don't know exactly when that resolution comes, but watching the signals clearly, the Fed, the COMEX inventory, the gold-silver ratio, the geopolitical backdrop, puts you in a much better position than most. Let me bring everything together. Goldman Sachs cut its silver price targets, and the primary reason is the Federal Reserve's slower-than-expected rate cut timeline. Geopolitical delays, particularly around oil-producing regions and the U.S.-Iran situation, have kept inflation stickier than anticipated, forcing the Fed to hold rates higher for longer. That creates near-term pressure on non-yielding assets like silver. At the same time, COMEX registered inventory has been declining, a trend that reflects the ongoing structural supply deficit in the silver market. Industrial demand from solar, EVs, semiconductors, and AI infrastructure continues to grow. Mine supply is constrained and slow to respond. The physical metal available for delivery has been shrinking, even as paper market trading continues at high volumes. These two stories, the near-term headwind and the longer-term structural fundamental, are both real, and they exist in tension with each other. Understanding that tension and knowing which time frame and which framework is most relevant to your own situation is the key to thinking clearly about silver right now. Thank you so much for watching this video all the way through. This channel is about giving you clear, honest, and useful analysis of what's happening in financial markets, and I genuinely hope this helped you see the silver picture with a little more clarity. If it did, please leave a like. It takes 2 seconds and helps more people find this content. Subscribe if you haven't already, because there's a lot more coming. As always, nothing in this video is financial advice. This is educational content meant to help you think, not to tell you what to do with your money. Do your own research, understand your own situation, and if you're making significant financial decisions, talk to a qualified professional. I'll see you in the next one.